One stock that can't seem to rally either is Apple. Since Apple went public on this day 38 years ago, happy 38th birthday, public market, the stock has soared more than 43,000%.
That's the chart.
Yeah, it's a lot of houses in Los Altos. Yeah. But Apple has been in trouble the last few months, now down about 27% from when it hit an all-time high in early October. However, your next guest says, despite Apple getting cored a bit, Apple is still set to double from here. Gene Munster is the founder of Loup Ventures. He joins us now from Chicago. Hey, Gene, I love you. I like your optimism, but a double from here, that is optimistic, my friend.
Yeah, it's another $1 trillion to market cap, but I want to put some context is that our goal here is to try to look through some of the noise that we've had over the past 6 weeks and think about what the true arc of this slope is that Apple is on. And backing out all the headwinds that Apple has had over the last month and a half is that the company is on a path to be a services company. We've talked a lot about that, but that narrative has far from been captured by investors. And we expect over the next year, as they anniversary this new reporting methodology, that investors will progressively understand that this business is not one that you need to sweat every quarter, and that, in fact, that there is some predictability and dependability into their earnings growth. And companies that have predictability and earnings visibility get high multiples. And we think about Clorox, for example, trading at 23 times, or Coca-Cola at 19 times. Apple now at 13 times. I think you can build a case over the next 3 years that as investors understand the visibility in this business, and this is going to be a big debate, is there really visibility or not? But I think that there is, that you can assume a 23 multiple on a, call it $15 number, and you can get to a $350 stock. And I understand that that may be hard for some people to believe, but ultimately I think that that's the trajectory that this company is on.
Hey, Gene, it's Tim. I tend to agree with you. I think they've really actually de-risked the release cycle for the company, and I believe a higher multiple on services is part of this blended new approach. How about those folks that say if shipments essentially are down or possibly contracting, that this installed base is nowhere near as profitable to be building this services business on? I don't agree with that, but I'd like to hear your pushback.
So I think that the hardware piece, you talked about the services segment, that 15%. What we're thinking about is the entire business. The hardware pieces included are going to start to operate like a services, a subscription type of business. If there is weakness, to answer your question, if there is weakness in the December quarter, they're doing some trade-in discounting. There is a case that there could be some slowdown in emerging markets. If there is slowdown, yes, we will be wrong in the near term on our prediction. I think the stock will trade lower. But I think ultimately is that the 18% base of global smartphone owners that are committed to Apple will stay committed despite any economic slowdown, and they will return and upgrade and buy additional services. So this is one where it really takes an investing mentality to pull through this. And it's not to make an excuse about any sort of near-term weakness. It's just simply to state that companies like this that are staples of our lives, I think Apple is one of those.
Gene, do we have any idea what the margins on the services side are? We kind of know what the margins on the phone are, but if songs used to be 99 cents, now they're $1.29. We buy an app for $2.99. What is Apple making on that?
So they're going to break that out for the first time. They've given some indications in the past, so this is our best estimate, is that the services margins are probably close to 70% gross margin, and the hardware margins are probably around 30%. So they're going to be breaking that out in this new reporting methodology.
Wow, 70% margins, and the growth there seems steady to you.
Yeah, it's a 20% grower. But again, the bigger picture here is that...
Any sign of a slowdown in that 20%, Gene?
No, I think that that's very stable, but I think this idea of, I just want to paint the picture, is more products that Apple is going to offer. I think they're going to make it easier to buy those on a kind of a yearly basis, and I think that there's an opportunity for that to fundamentally change how people buy Apple products.
Hey, Gene, Pete Najarian, real quick question about wearables. Where do you stand on that, and how big of a run does that have in front of it still, in your opinion?
It's a big segment. It all plays into this idea of Apple's the company where we get our tech, whether it's a computer, a smartphone, or a wearable. It's a small part of their business. The watch is about 4% of revenue. It's growing fast, about 50% last quarter, but it's still so small, it doesn't change the overall needle, but it does example of one of those key products as part of the whole ecosystem.
Gene Munster, very bullish on Apple. Sees another $1 trillion coming, guys. Gene, we appreciate your view. Thank you very much.
Thank you.
All right, here's the question. Now we'll cut Gene off so he can't respond.
Sure.
What do you think? Can Apple double in the next few years?
Absolutely. It's why I'm buying it now, because I think people are very short-sighted. Now, in the short term, can it go lower? Absolutely can. I'm not calling a bottom for Apple right now. But when you look at where do you want to see your growth and where do you want to see your gross margins that are the highest, you want to see them in those areas like where we're seeing them in services. When you look at 330 million subscribers to the services side of it, that's up 50% year over year. I mean, this is a company that continues to show incredible growth. By 2022, 2023, services are going to be about a $100 billion business. Right now, you look at wearables, it's $4 billion per quarter. That's obviously going to grow as well. So when you look at those growth drivers, you look at the hardware side, everybody, I think, is focused on the wrong thing. It always reminds me of Microsoft. People are looking at the wrong thing. They're not looking at growth. They're looking at the old line tech.
Well, and if you're looking at the chart, you could make an argument this stock could go down to 145, but I agree with both these guys. I don't need it to go to 350, by the way. And this is one of those stocks where we always say this, are you a trader or are you an investor? And if there's a stock you want to be comfortable being an investor on, it's the one that actually has $50 billion a year in free cash flow and is trading at 12 times next year's numbers. That's a number that even if you had a decline in shipments, you want to own.
You want to hear something incredible?
We have a choice.
Yes, of course.
Hold on. This is everybody out there driving home. I'm going to blow your mind right now. In 1980, when Apple went public, Massachusetts, the state, barred any citizen of that state from buying
It was too risky.
Apple's IPO because they viewed it as too risky and it didn't have a solid earnings foundation.
Right. And if you bought one share at $22, it's worth $95,000 now.
Great call by Massachusetts.
Blew my mind.
All right.